Be in touch with the results of your decisions and constantly be reviewing your performance. Are you trading profitably? Have you had 5 wins in a row, or have you had 5 losses in a row? If you are on a losing streak, will you be in touch with your own emotions and maintain your composure, or will you let your judgment be impaired? I cannot emphasize enough just how important the following steps are. You must take the time to prepare. You must work hard. You must plan your trades. You must take the time afterwards to review your trades, and you cannot do it alone. You cannot succeed on your own. There is so much value in sharing ideas and learning from a community of traders and, should you have one, your mentor. Consider skill and discipline to be your trading muscles. Muscles require exercise to grow, and, once you've grown them, they need to be exercised or you will lose them. That's what I experience every day, continually exercising my ability to practice self-control and discipline. Some of these skills, however, are comparable to learning to ride a bicycle. Once you've learned it, riding a bike is a skill that can't be taken away. Once you've learned it, the skill of identifying a good stock to trade will not go away. But remember, discipline is something you will need to constantly work at to be a successful trader. You've entered a profession in which you will always be learning. That's great and it's very stimulating. But it's important to remember that if you start to get overconfident and think you've outsmarted the market on trading wisdom, or that you don't need to learn anymore, you'll often get a quick reminder from that market. You'll lose money and you will see that the market is correcting you. I will reiterate, being able to make quick decisions and being able to make and then follow your trading rules are critical for success in the market. As you continue through this book, you are going to read much about risk management. Everything that traders do comes back to risk management, because ultimately it is the most important concept for a trader to understand. All day long, you are managing risk. Related to this is the ability to manage risk so that you will make good decisions, even in the heat of the moment. That's the next rule of day trading. Rule 6. Your broker will buy and sell stocks for you at the exchange. Your only job as a day trader is to manage risk. You cannot be a successful day trader without excellent risk management skills, even if you are the master of many effective strategies. As mentioned before, day trading is a very serious pursuit. You must treat it as such. Only you can decide how much of your account you can afford to potentially lose at any one time. You have to take into consideration your finances, your skill and your personality. But never forget the previously explained 2% rule. Do not take a trade if more than 2% of your account will be put in jeopardy. It very simply is not worth the risk. There's a very simple truth that you must accept. You should not expect to be right all of the time. It's impossible to be. Trading is based on probabilities, and it requires a great deal of patience to identify setups with attractive risk-reward potential. I'm a consistently profitable trader, but 30% of my trades result in a loss. I don't expect to be right every single trade. If you owned a small business, you wouldn't expect it to be profitable every single day. There would be days when you wouldn't have enough customers or sales even to support your staff or your lease. But these would be more than offset by days when your business prospered. If you examine the work of most successful traders, they all take many small losses. Their results are littered with numerous small losses of 7C, 5C, 3C, and even 1C per share. Most good day traders have few losses that are more than 30C per share. Most winning trades should work for you right away. One of the fundamentals you must learn from this book is that everyday trading strategy comes with a stop-loss level, and you must stop out from stocks that trade against your strategy. Imagine for a moment that you are shorting a stock below an important resistance level, and you are waiting for the price to go lower. That is fine. But suddenly the price turns against you and breaks the resistance level and trades higher. Now your original trade plan is obsolete. You have no reason to stay in the trade. You cannot wait in the trade in the hope that the stock may trade lower again. That is wishful thinking. You can wipe out your trading account with one crazy move. The stock may or may not trade lower again, but above the resistance level you have no reason to be short in the stock. If the stock was weak and comes back below the level, you may enter the trade again. Commissions are cheap, so accept a small loss and get out. You can always get back into the trade when the setup is ready. Those who never master this fundamental rule will fail. This is a common problem amongst new traders. They don't accept the small loss. You must work at this while trading in a simulator. You should move to live trading only if you have mastered accepting and respecting your stop loss. If you don't know where your stop loss is or where it should be, it means that perhaps you should not be in that trade in the first place. It means you have not planned it correctly. It also means you should step back to reading about and reviewing your strategies and return to again trade in the simulator. Consistently profitable traders just make sound and reasonable trades. They accept that they cannot control the market or results on every single trade, but they stick to their plan and control their capital. Often you can review your profit and loss at the end of the month. Professional traders often review their P&L quarterly and then make a decision on their performance and adjust their trading strategies accordingly. Many traders think a good trading day is a positive day. Wrong. A good trading day is a day that you were disciplined, traded sound strategies, and did not violate any trading rules. The normal uncertainty of the stock market will result in some of your days being negative, but that does not mean that a negative day was a bad trading day. Chapter 4: How to Find Stocks for Trades. You are only as good as the stocks that you trade. This is a famous expression in the trading community. There are too many new traders who do not know what a good stock to day trade is nor how to find one, and they waste too many trading days mistakenly believing that the market is impossible to day trade in. You can be the best trader in the world, but if your stocks do not move, nor have enough volume, then you cannot make money consistently. Trading a stock that doesn't move is a trading day wasted. As a day trader, you must be efficient with your time and buying power. Now, we don't want stocks to just move, but we seek stocks where we can identify that they are about to move in a certain direction. It is possible that a stock that moves $5 intraday may never offer us excellent risk-reward opportunities. Some stocks move too much intraday without foreshadowing their direction. Your next challenge as a new trader is how to find these stocks. I often get emails from traders saying that they struggle with how to find the right stocks to trade. Many of them understand how trading works and have a proper education and the right gear for day trading, but when it comes to actually finding stocks to trade in real time, they are clueless. I certainly experienced this as a new trader. If you learn the strategies explained in Chapter 7, but you cannot make money consistently, it is possible that you are in the wrong stock. Again, you are only as good as the stocks you trade. You need to find the stocks that are in play by day traders, or, as I call them, stocks in play. There is more than one way to select stocks in play and make money trading them, and there is definitely more than one correct way. Some traders trade baskets of stocks and indexes. Some day traders like my friend trader Brian trade exchange-traded funds exclusively. Many have developed proprietary filters to find stocks. Others concentrate on trading the markets as a whole with index futures. Often professional traders at the trading desks of the big banks simply trade in a sector like gold or oil or tech. But remember, we are retail traders with limited amounts of capital, so we must be efficient with selecting our stocks in play. A stock in play is a stock that offers excellent risk-reward setup opportunities. Opportunities where your downside is 5C and your upside is 25C, or your downside is 20C and your upside is $1 that's 1.5. You can regularly read a stock in play that is about to trade higher or lower from its present price. A stock in play moves, and these moves are predictable, frequent, and catchable. A good intraday stock offers numerous and excellent risk-reward opportunities. Every day, there are new series of stocks that are in play. Trading stocks in play allow you to be the most efficient with your buying power. They often offer much better risk-reward opportunities intraday and allow you to execute your ideas and trading rules with more consistency. Trading the right stocks in play help you to combat algorithmic programs. Stocks in play. What are stocks in play? I explain in detail later in this book how to find them, but they could be, in no particular order. A stock with fresh news. A stock that is up or down more than 2% before the market open. A stock that has unusual pre-market trading activity. A stock that develops important intraday levels which we can trade off from. You must remember that retail trading does not work on all stocks. It only works on the stocks that have high relative volume. Some stocks like Apple Incorporated will on average trade millions and millions of shares each day, while other stocks on average might trade only 500,000 shares each day. Does this mean you should trade Apple only? No. High volume will be relative from one stock to another. You don't just look for high total volume. There are some stocks that on average will trade with much volume. You need to look for what's above average for that specific stock. 30 million shares of Apple traded in one day might very well not be higher than usual. Do not trade Apple unless it has a very unusual trading volume. If trading volume is not higher than normal, it means that the trading is being dominated by institutional traders and high-frequency trading computers. Stay away from it. Figure 4.1- Apple Daily Chart for Summer 2016. Days that Apple had a significant relative volume are marked. Those days were suitable for day trading Apple. Take a look at Figure 4.1 above, the Apple Daily Chart for the summer of 2016. As you can see, there were only 2 days that had high relative activity. They're marked with arrows on the chart. Interestingly enough, when you take a close look at the chart, you realize that on those days the stock gapped up or down. I marked those price gaps on the chart. If you wanted to trade Apple, you should have traded it only on those days. The other days were comprised of just normal, high-frequency, algorithmic trading. Retail traders should stay away from stocks that are trading normally. The most important characteristic of high relative volume stocks is that these stocks trade independent of what their sector and the overall market are doing. When the market is weak, it means that the majority of stocks are selling off. It does not matter if it is Apple, Facebook, Amazon or Exxon. When the market is strong, the prices of the majority of stocks will be going higher. Similarly, when you hear someone say the market is bear or collapsing, they don't mean a specific stock. They mean that the whole stock market is losing its value, all stocks together. The same is true for specific sectors. For example, when the pharmaceutical sector is weak, it means all of the pharmaceutical companies are losing their values together. How do you recognize the behavior of the market? Index funds such as the Dow Jones Industrial Average or the S&P 500 are usually good indicators of what the overall market is doing. If the Dow Jones or the SPY are red, it means that the overall market is weak. If the Dow Jones or the SPY are strong, then the overall market will be going higher. The behavior of stocks that have high relative volume is independent of the overall market. They are stocks in play. Every day, only a handful of stocks are being traded independently of their sector and the overall market. Day traders trade only those stocks. I sometimes call those stocks alpha. In the animal kingdom, alpha is a predator at the top of a food chain upon which no other creatures prey. In day trading, alpha stocks are the ones that are independent of both the overall market and their sector. The market and high-frequency trading cannot control them. We call these stocks in play. Therefore, the next rule is about stocks in play. Rule 7. Retail traders trade only stocks in play, high relative volume stocks that have fundamental catalysts and are being traded regardless of the overall market. We know we need high relative volume, but how much volume is enough? I don't trade stocks with an average daily volume of less than 500,000 shares. You need certain liquidity in the stock to be able to get in and out of the stock without difficulty. For example, if you buy JP Morgan Chase at $30 and you set an exit price for $29.85, can you actually get out near $29.85? Or, because volume is so low, do you have to sell at $29.50 to exit? If you are trading JPM and you conclude you should exit at $29.85, but really you cannot exit until $29.50, then this is not a good trading stock intraday. Stocks in play have sufficient liquidity so that you can exit without unexpected slippage. What makes a stock in play? Usually it is the release of fundamental news about the stock either the day before or during the same trading day. Important news or events for companies can have significant impacts on their value in the market and therefore act as fundamental catalysts for their price action. As mentioned in Chapter 2, some examples of the fundamental catalysts for stocks that make them suitable for day trading include earnings reports, earnings warnings, pre-announcements, earnings surprises, FDA approvals, disapprovals, mergers, acquisitions, alliances, partnerships, major product releases, major contract wins, losses, restructurings, layoffs, management changes, stock splits, buybacks, debt offerings. I check the news on all stocks up or down more than 2% pre-market and shortlist my Gapers watch list. Stocks in play the day before are often still in play for a few days after. In Chapter 7, I explain specific day trading strategies such as momentum, reversal, VWAP, and moving average. For the moment, your main question needs to be, how do I find the stock for each strategy? I categorize stocks for retail trading into 3 classes. Based on my experiences, this categorization provides some clarity on how to find stocks and on how to adopt a strategy for them. Float and market cap. Before explaining the 3 categories, let me explain the definition of float and market capitalization, or market cap. Float means the number of shares available for trading. Apple Inc., for example, as of July 2016, had 5.3 billion shares in the market that are available for buying and selling. Apple is considered a mega cap stock. These stocks usually don't move much during the day because they require significant volume and money to be traded, so Apple shares might on average change by only $1 or $2 each day. They are not very volatile and therefore day traders don't like trading them. Day traders look for volatility. On the other hand, there are some stocks that have very low float. For example, Seska Therapeutics Inc. has only a 1.2 million share float. This means that the supply of shares of Cool is low, and therefore a large demand can very quickly move the price of the stock. Low float stocks can be volatile and move very fast. Most of the low float stocks are under $10 because they are early stage companies which for the most part are not profitable. They hope to grow, and by growing further, they issue more shares and raise more money from the public market and slowly become mega cap stocks. These low float stocks are also called small cap or micro cap stocks. Day traders love low float stocks. Now let's return to those 3 categories. The first category consists of low float stocks that are priced under $10. These stocks are extremely volatile, moving 10%, 20%, 100%, or even 1000% each day. Yes, there have been those kinds of moves. You must be careful with this category. Just as you can turn your $1,000 into $10,000 in a single trade, your $1,000 can just as easily turn into $10. Low-float stocks under $10 are often highly manipulated and difficult to trade, and therefore only very experienced and highly equipped retail traders should trade these stocks. I personally rarely trade in them. If someone claims to have turned $1,000 into $10,000 in a month, and if it's true, they must have traded this type of low-float stock. No beginner or even intermediate trader can trade with such accuracy and efficiency. If novice traders tried trading low-float stocks that are under $10, they would more likely turn their $1,000 into nothing in a matter of days. When it comes to low-float stocks, the bull flag momentum strategy, which I detail in Chapter 7, works best. The other strategies in this book are not suitable for low-float sub-$10 stocks. You generally cannot sell short low-float stocks that cost less than $10. For short selling, you need to borrow shares from your broker, and it's rare that a broker will lend you such volatile stocks. Even if your broker is willing to lend them to you, I strongly advise that you do not attempt to short sell them. They can easily surge and you will end up wiping out your account. You definitely can become a full-time profitable day trader without short selling risky stocks, so leave that to the Wall Street professionals. Trading low-float stocks is very difficult for the new trader. It is difficult to read the direction of their next move, and therefore they are very difficult to manage your risk while trading them. I discourage new traders from trading low-float stocks. When the new trader is wrong, the loss is such that it wipes out many gains. The second category is medium float stocks in the range of $10 - $100. These stocks have medium floats of around 10 million to 500 million shares. Many of my strategies explained in this book work well on these stocks, especially the VWAP and support or resistance strategies. Medium float stocks that are more expensive than $100 are not popular among retail day traders, and I myself avoid them. You usually cannot buy many shares of them because of their high price. Therefore, it is basically useless to day trade them. Leave them for the institutional traders. The third category of stocks for trading is mega-cap stocks like Apple, Alibaba, Yahoo, Microsoft and Home Depot. These are well-established companies that usually have over $500 million in public shares available for trading. These stocks are traded in millions of shares every day. As you may guess, these stocks move only when large institutional traders, investment banks, and hedge funds are buying or selling large positions. Retail traders like us, who typically trade 100 to 1,000 shares, usually cannot move the price of these stocks. Retail traders should avoid these stocks unless there is a good fundamental catalyst for them. From the strategies set forth in Chapter 7, reversals and moving average strategies usually work well on these stocks. Do not forget though, unless there is a fundamental catalyst, these stocks are being heavily traded by computers and high-frequency traders and are not suitable for retail day trading.